This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, new reports show the end of the American dream is near as consumers are faced with doing the unthinkable. And it's going to leave you speechless at what Americans are having to do now to deal with high inflation because they're faced with selling their future. Plus, the bailouts, well, they're back and even bigger than before. And the U.S. banking system is facing its latest problem. And at the same time, we have new evidence that shows the U.S. economy is now within 12 months of its next crisis. Plus, we have a sponsor for today's show. You may remember Metre Pharmaceuticals. We had them on the show months ago. They're trading under the symbol on the NASDAQ. MIRA. You can check them out because they had some big news today that we're going to talk about, and that sent their stock soaring. Now, back when we featured them on the show, we told you what our price target was for the stock. It's hit it not only once, but twice. Now we're going to show you why their next move could be 40% or more. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's go to Bloomberg, where we picked today's story up with a headline: Taiwan export orders fall at a slower pace on China demand rebound. And the focus of this headline is about how China is coming back online and the perhaps hope that the global soft landing is going to rest on the back of China's consumers. And now we can see that exports out of Taiwan are softening a bit. But the real part of the story is that exports orders are indeed falling. Now, maybe they're slowing at their pace, but that is not the issue, because let me show you what this means. When you see export orders continue to fall, what has dire consequences, not just for the Taiwanese economy, but for the entire global economy. And orders to Taiwanese companies from overseas clients declined 4.6% in October compared to the same month last year. This according to the ministry in Taipei on economics. That was the smallest decline since September 2022 and milder than a 7.6 forecast by economists. And this was an indication that China's factories are ramping up production. Now, again, I want you to see this is all about the revival of China's economy and the global economy. The issue here is if we continue to see exports fall, well, again, it has major repercussions for the U.S. and global economy. Ahead of this peak holiday season is demand from China and Hong Kong. Taiwan's second largest source for orders after the U.S. rose roughly 1.2%. This is the first increase since March of 2022. And this is exactly what everyone's looking for, is hope. The problem is, if hope doesn't manifest into an increased trend of growing exports, well, let me show you what's about to come, not only to the global economy, but here in the U.S., as we look at the data, we see exports of goods and services. This is headed out of the United States against the 4-week moving average of initial claims. And the key part here is the global economy matters so much that it's not about internal consumption. And this is what we hear experts say about China. If only they could get their internal consumption up. It's about exports, because we are in a global economy now, and look at what happens. And here we can see when exports head down, that is when the blue line shown on a year-over-year rate of change, and particularly when it breaks through that horizontal black line and goes negative. But I want you to notice that any point you see the blue line making fairly big moves down, and now there's times that it doesn't, but notably what you tend to see is a rise in unemployment claims, shown as a 4-week moving average of initial claims in red. Now, there are times when the economy is booming and exports slow that you don't see that, but more often than not, what you see is a rise in unemployment claims. So as we look at this data, we see, well, maybe things are just slowing down in Taiwan, and that could be a good thing. And we look at the data and say, well, maybe things are getting slightly better in the U.S. They're just slowing. They're still getting worse, but not that much. The issue still is, how long do you keep the employees around if you don't have work? Well, that's the problem that we see, and why unemployment claims are likely to rise. But let's take a look at what's going on in China now, because the bailouts, well, they're getting bigger, just as we said they would. As China pauses rate cuts, its focus shifts to credit stability. Now, this is very interesting. Is you might think, well, wait a minute, wouldn't credit stability occur when they cut their rates? Well, that makes sense, but let's take a look at why China suddenly doesn't want to cut rates anymore, particularly until the Fed starts to cut. That shift in focus was apparent last Friday when the PBOC and other financial regulators told the country's biggest lenders and asset managers to meet, quote, all reasonable funding needs from property firms. And that wasn't a suggestion, it was an order. If they want to borrow money, you will lend it to them. That is what China was telling the banks. They said the banks should coordinate credit growth from now through early next year, adding that a stable expansion of credit can help boost the economy. Well, I've got some good news because they're right about one thing. In a debt-based economy, an expansion of credit is exactly what you need. And this is one of the problems the U.S. banking system continues to face. That means signal a smoother pace of credit support, as loan growth is usually slower in the final months of the year before banks push to hit their lending targets in the first quarter. This year, credit growth was strong in the first 3 months because of post-pandemic reopening, but now borrowing demand has been weak ever since. And that's simple reason why. The global economy is slowing. U.S. consumer demand is slowing. Internal demand in China is slowing. And so yet, what do we see here? The banks are being forced to lend, and that means China is going all in on this deal. Look what they're saying. China drafts list of 50 property firms eligible for funding. Again, this isn't a suggestion of what they're going to do. It's telling these banks, you will lend. And part of the reason here is you're wondering, why aren't they cutting rates here? Isn't that the simplest solution? Well, the problem they're having is everyone thinks that central bankers have control of their currency. So the yuan's been falling in value. That's because everyone thinks the central bank keeps cutting rates. We've said the yuan is falling in value because global demand is going down, particularly for Chinese goods. And if you're not buying in China and exporting out of China, well, you don't need yuan. But that doesn't mean everyone thinks that's how it works. So China doesn't want to cut rates anymore because they think it will cause their currency to devalue even further, and that will lead to more money exiting the country. So now they're focused on lending, and that means you will lend. The list includes both private and state-owned developers and is intended to guide financial institutions, notably not suggest, not hint, guide financial institutions as a way support for the industry via bank loans, debt, and equity financing. It couldn't be determined which other developers. Well, the list was pretty big to begin with, suggesting is if any developer comes to the bank and wants money for any reason, well, you'll give it to them because we need lending growth in a big way. And that's something that the U.S. economy is going to be faced with the exact same issue. As you can see here, bank loan volumes plunge despite huge deposit inflows as the Fed's rescue fund usage surges to new record highs. So we know that the small and mid-sized regional banking system is still in big trouble. And one of the things we've said they need to do is expand their loan book in a big way. And the problem is everyone thought that the economy was doing so well that consumers would be willing to pay higher and higher interest rates to borrow money. The problem is that didn't actually occur, suggesting that the economy isn't booming and that the Fed is artificially raising rates. They've inverted yield curves, inverted money curves. They've constricted the creation of credit, and that is leading to a collapse in lending demand for the banks. This is bad news because they need higher interest rates to attract deposits and keep money on the books. This is, again, why when we see the Fed's usage of their emergency funding facility continue to go higher, it tells us the small and mid-sized regional banks are in bad shape. And sure enough, we see here loan volumes plunged last week for large and small banks, minus 5.4 and minus 22.6 billion respectively. If we take a look at the commercial industrial lending data, here we can see on a year-over-year rate of change, looking at the weekly data that's provided by the St. Louis Federal Reserve, down minus 1.3%. And I want you to note that when you start to see contractions in bank lending in a debt-based economy, it tells you that there is a recession coming because the commercial banks are the only institutions in the country that can create new money. Not the government, not your credit union, nobody but the commercial banks. So the problem is when you see the lending book contract, well, it means they're destroying money as well, and that gives us the signal that tells us the U.S. economy is now within 12 months of its next crisis, which is just validated by, of course, the U.S. leading indicator from the Conference Board that says their leading indicator tumbled for the 19th straight month, the worst streak since Lehman. Of course, what they're notably here is the biggest contributor was building permits. The biggest negative contributor was ISM new orders. This is, of course, factory sector, which we've been telling everyone is in big trouble, and consumer expectations. But here's the real issue. We take a look at this chart and you see the leading index on a year-over-year rate of change. Whenever it starts going negative like it is now, you'll notice there's this pink shaded bar, and that means there's a recession, an official recession. And what it's telling us is that we are now within 12 months or less of a recession. And this bodes a big problem as we head into Black Friday. Of course, that's what we're doing out shopping. We're looking for deals. Actually, we're looking for shoppers. Don't think there's going to be that many this year. And that's the challenge, because retailers, wholesalers, they're loaded up with inventory. They need to move this, and they need to move it now. The problem is the U.S. consumer is doing the unthinkable to get by. It's not to go shopping. As Black Friday Cyber Monday spending projected to hit new all-time highs, and that would be huge because consumers claim they're sticking with their budgets. Well, we'll see if they do. Consumers plan to spend an average of $567 during the Black Friday Cyber Monday shopping event, up 13% from last year, if you can imagine. But consumers, they're looking for the best deals because they're being squeezed by high inflation. We're going to show you just how bad. The new result is a record for Deloitte's annual Black Friday Cyber Monday survey, suggesting 84% of shoppers feel confident enough to stick with their budgets, they said back in September. In order to stay within their spending limits, many consumers plan to do much of their shopping during Black Friday and Cyber Monday. Well, 4 in 10 expect to finish their shopping during that period. Now, keep in mind, the survey was taken toward the end of last month, and we know the U.S. economy, while it doesn't move really fast all the time, it is rather dynamic. And what was notable coming at the end of October, well, that means the student loan repayments had started. We're seeing that people are running out of money. And now let's take a look at some other reports. As you see, the U.S. consumer is in bad shape. 60% of Americans are now living paycheck to paycheck heading into the holidays. This doesn't bode well for spending at all. According to Lending Club, they see that 60%, this is unchanged from last year, back when people had pandemic money. And according to their study, 4 in 10 consumers consider themselves worse off relative to 2022. Well, if you're worse off and you can't run your credit cards up because you're maxed out, it means your spending is likely to head lower. And half of consumers plan to take on more debt to pay for the holiday expenses. This, again, if the banks will let them. Only 23% have a plan to pay it off within 1 to 2 months. And if that's not bad enough, 74% of Americans say they're stressed about finances, according to a CNBC Your Money Confidence survey conducted way back in August. So you can only imagine that that now is probably worse. Inflation, rising interest rates, and a lack of savings are contributing to those feelings, as they should. It's not just inflation, it's wages, because we've talked about this on the show before. If wages are growing at a faster rate than inflation, then it's not a big deal. You can afford it. If inflation's at 10%, your wages are growing at 12%, well, yeah, it's not fun, but you got the money to pay it. The problem here is the picture for the U.S. consumer continues to worsen. Here you can see average retail sales is shown in blue on a year-over-year rate change against total compensation, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That in red also on a year-over-year rate change. And what we can notably here see is total compensation. There was a bit of a revival. It kind of peaked up, and now it's rolling back down. And that hope that we saw months ago in these reports that suggested that, yes, consumers are going to maintain their spending, well, the trend is to the downside, suggesting that due to high inflation, higher energy costs, and higher food costs, that consumers are going to have less money to spend this holiday season, particularly when faced with the fact that banks are tightening lending standards on credit cards. So we know that consumers are tapped out in a big way on these. Some people may have some margin, but the banks aren't extending more credit. And what does that mean? Well, it suggests that they're having to go other places to get money. And that means that consumers are having to sell their future now to get by, and that's not a good situation. As consumers pull cash from retirement accounts amid budget stress, and I know some of you, this is absolutely shocking, how people could even dream of doing something like that and selling away their future to get by today. The issue is they're not taking this money and going out and spending it on goods and services. They're using it to survive, because as we know, inflation now is still way too high, compensation growth not high enough, and unemployment claims are likely to soon head higher, particularly for those stuck on unemployment, as we've noted, as that's broken to almost 1.9 million Americans. Some 2.3% of workers took a hardship withdrawal last quarter, up from 1.8% a year earlier. This, of course, means the trend is getting worse. The two top reasons given for the uptick were to avoid foreclosure for homeowners or eviction for renters, and, if you can imagine, medical expenses. So as you can see, this is for survival, as Americans outside the wealthiest quintile have run out of extra savings generated early in the pandemic and now have less cash on hand than did when the pandemic began. This according to the Federal Reserve. So as we talk about holiday spending and people looking to spend more money, well, if you're worried about paying your mortgage or your rent, or you can't cover your medical expenses, you're certainly not going to spend a whole lot on the holidays. And we can see that here as the personal savings rate. We note that it continues to decline. The only question is, as it reaches extremely historical low rates, the question is, how long will American consumers continue to drain their savings down to consume before they actually hit the panic button and go in reverse? And notably, we see when consumers start to save more money, retail sales go down. We saw that reverse as savings drop, retails went up. But what we know is throughout history, when savings rates rise, retail sales go down as consumers are running more and more out of money, having to draw out of their 401ks. The only question is, when do they put the stop button and say, you know what? I don't care how big the deals are on Black Friday and Cyber Monday. I'm done spending because I can't keep giving away my future. In the third quarter, 2.8% of 401k retirement account participants took a loan against their account, up from 2.4% in the third quarter. So those that can't withdraw, well, they're borrowing. And overall, about 1 in 6 workers, or 17.6%, had an outstanding loan. That's up from 17.2% last quarter and 16.8% in the third quarter of 2022, suggesting that consumers can't get money from the bank, so they're going to the one place you should never touch. I know many of you agree with me. You shouldn't be drawing, shouldn't be borrowing from your 401k unless it's emergency, but look at the trends. We're seeing it get worse. And loans taken from 401k savings generally must be paid back as long as 5 years with interest. However, some workers have been taking what's known as an in-service withdrawal, where employers allow these withdrawals that include taxes and penalties, but aren't required to be paid back. Of course, we know that comes with that 10% early withdrawal penalty. Not a good sign for consumers as they head into tax season next year. It's not a good situation. It tells you that we're unlikely to see a booming holiday season. Of course, we'll get the data on that here within another week. We'll have a good idea of what consumers did. But based on what I'm hearing from people that are working at retailers, foot traffic is down, spending is down, and they're starting to shed employees, as we've talked about in prior shows. Overall, the average retirement account balance decreased slightly from the previous quarter. The average 401k balance was only $107,700, down 4% for the second quarter. And over the past 5 years, that 401k balance was essentially unchanged, putting more consumers in the position as they draw down their account. They're just selling their future, putting themselves in a situation they're going to have to work longer, and that does not lead to a healthy economy. But now let's talk about something we see a healthy movement, and that is our sponsor for today's show, Metre Pharmaceuticals. You can find them under the NASDAQ, under the symbol MIRA. Let's take a look at what's going on with them and why we think their stock could make another 40% move. And here you can find Metre on the web at Metre Pharmaceuticals. We've got links to everything in the description and pinned comment below. Let's take a look at what their big news release was, as Metre announced exclusive licensing agreement for oral ketamine analog Ketamir 2. And under exclusive licensing agreement, Metre will have the exclusive rights in the US, Canada, and Mexico to develop and commercialize Ketamir 2, a novel oral ketamine analog designed to revolutionize the landscape of depressive disorder treatments. This transformative collaboration includes a $3 million line of credit extended by Metre Logics to fund the initial development of ketamine 2. And it's a unique patent pending compound that's under investigation to potentially deliver ultra rapid antidepressant effect as nearly as 4 hours after dosing, providing hopes for individuals battling treatment-resistant depression and major depressive disorder with suicidal ideation. And from Dr. Adam Kaplan, Mere's president and chief scientific officer, he said, in our continuing pursuit to alleviate the burden of treatment-resistant depression, the treatment of ketamine 2 offers a promising beacon of hope. I'm honored to lead its development journey, and I'm optimistic about its potential to transform the lives of individuals suffering from TRD and suicidal depression. And one thing that we think that this could also transform is your trading account. Let's take a look back at when we featured Mere on the show, what's happened with the stock, and where we think it's headed next. So here you can see we've had them on the show right here where I circled in red, and that stuck off way up into the supply zone. We said that was a likely move, and those that jumped on it early, well, they saw it. And if you didn't, I know many said, well, wait a minute, it went down. Well, that does tend to happen sometimes, but look what happened. We tagged again that spot again, giving everybody that bought here that second opportunity as an exit, and now we see a third opportunity to get in. Again, you can see where the sellers are at 637. Potential breakout over the sell zone puts you up in the $7 range. And if we take a closer look at the 90-day chart, here you can see the supply zone. This is where buyers are at in that $3.42 range. You can see over the 90 days, most of the shares were traded at $4.47, showing the buyers are coming in and holding support at a higher level. That takes this a breakthrough of those shorts up to the $7 range. And there, my friends, is your catalyst for a 40% move on Mere. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.